Hi everyone, welcome to educational video series from Traderz Hut. I am RAJU ANGADI VISHWANATH, a SEBi registered research analyst, chartered market technician and a certified financial technician from MTA US. So in this video, we are going to learn how to trade like a champion trader. All might be thinking to become a champion trader, we need to have a very robust or best strategy in the world to become a champion trader. It's not like that. It's completely untrue or it's completely false. What I can say, a simple rules, what we are going to learn here today can make you a successful trader, can make you a hero from zero if you apply them in a disciplined manner. So we are going to learn the three special pillars like Ashoka Stambas or Ashoka pillars, the simple yet very effective and powerful three mantras which we are going to learn and apply to become a successful trader so that all of us can march towards the financial freedom. So come on guys, let's start the RMT, the three powerful mantras. The power of defense is the starting point for any war or any business or any act or any game what you're playing. If your defense is strong, you are going to win the bigger championships. As quoted by the Becky Novak, offense wins the games, but defense wins you championships. We all know, most of us know Rahul Dravid, the wall of cricket, what we used to call him. Why? Because Rahul Dravid's defense was such strong that he can defend the best of the best balls and best of the best bowlers, and whenever the bad balls comes he used to punish them, so that's why he was called the wall of cricket. So again I will repeat, offense can win you games, attack can win you games, aggressive trade can win you games, but if you have a defense stronger, consistently you are in the game and you are in the trade, so that you can win the bigger championships in trading. That's why power of defense is very much important. The first mantra is risk management. What you call it as triple R, risk reward ratio. So always managing your risk is the key to become a successful trader over a long run. You know, a trader's lifespan is 4 months, 4 to 6 months, as quoted by one of the best brokers in India. In one of the sessions where I attended, he told that a trader's lifespan is 4 to 6 months. So you won't believe, traders come in, traders go out. That's why we face a problem. What is the major problem? It's not the analysis. You can take advice from anyone also and you can trade. You can take advisory, then you blame the advisor, or you can take advice from a friend. There you blame the friend if you lose, or a relative if you lose. But if you know what you are doing, then you know what is the risk you are taking. Warren Buffett has said, you have to understand first what you are doing. Even our financial guru of ancient times, Chanakya, said, first know what you are doing, why you are doing, and what are the consequences of it. That's why the risk, money, and trade management needs to be understood before taking any trade. Trading is like pulling an arrow from a bow. Like Arjuna, how he pulls arrow, and once it is left, it is finished. Either it has to hit the target or it has to miss the target. Only to stop loss or target is there once you take a trade. So before taking a trade, understand the risk management. In the next section, we are going to discuss money and trade management. The first mantra is risk management. Come on, friends, let's learn the risk management and how can we manage the risk in a proper way in our trading. Never enter into a trade setup without establishing the triple R, risk reward ratio. Preservation of capital is key to your trading. Why you need to protect your capital? If you lose 50 rupees out of 100 rupees capital what you have, you are losing just 50% of your capital. To make that 50%, you have to make 100%. if you lose from 100 rupees, your capital becomes 50 rupees. It's 50% loss. That 50 rupees needs to again come back to 100. You need to double your money. 100% needs to be gained. So it's a percentage game. So let's see now what is the beauty of risk management and how it is we are going to understand in a good and a better way. Let us say we are going to take a trade and a stock is trading at 100 rupees. So first trade we place a stop loss of 10 rupees. That is our stop loss. And the target what we have kept set aside is 20 rupees. 120 is the target. Then if you are buying at 100 rupees, stop loss is 90. Let's make the life simple. 120 is the target. What we have kept 100 rupees is buying price. And buying price is 100. And stop loss is 90. So what becomes your risk reward ratio? 10 rupees is your risk and reward. Reward is potential, risk is guaranteed here. So always see the risk side. Always have a risk reward ratio of 1:2 or more in your trading. That is the basic rule. If you are risking 10 points or 10 rupees, then your profit should be 20 points or 20 rupees. Simple as that. Let us repeat the same trade for 10 times. We buy a stock named X at 100 rupees and our target is 120. Stop loss is 90. 5 times we win, 5 times we lose. Trade 1 we win, make a profit and of rupees 20. So 120 profit booked. Again 100 rupees we buy trade 2. We book a profit at 120, 20 rupees profit. Trade 3 is a loss, trade 4 is a loss. The same goes on. 5 trades we make a profit, 5 trades we make a loss. So 20 rupees is your profit when you make 20 points or 20 rupees and into 5 trades you win. So 100 rupees or 100 points is your profit. Out of 10 trades, 5 trades are winning trades. 5 trades you lose. 10 into 5. Rupees 50 you lose or 50 points you lose. So 100 minus 50 is 50 points or 50 rupees you are going to win. What is the moral of the story here? Most of them ask, if you are asking your advisor, ask that you have a 95% accuracy, 90% accuracy. You know, best of the best traders in the world, Paul Tudor Jones, Dan Zinger, many of them, even Rakesh Chunjunwala doesn't have accuracy of 30 to 50 or 60%. But their risk reward ratio was much bigger. That's why they made good enough money. Whenever they took a risk, they made big profits and losses were small. That's why the money making starts. So always have a better risk reward ratio. Never ask, even if you are taking advice, never ask your advisor what is your accuracy. Ask him or her what is your risk reward ratio. That is the first point to be noted, friends. Now let us continue with the first mantra, risk management. 4 times we win instead of 5 times. 10 trades we take, 4 trades we win. 80 rupees is your profit and 6 trades we lose. Means 4 into 20, 80 is the profit. 6 trades we lose out of 10 trades. Still we are in profit of 20 rupees or 20 points. Even though gross 25% you take it as a cost, 15 rupees is your profit. Even if your accuracy is 40%, 1:2 risk reward ratio, you are going to make money. That's the beauty of risk reward ratio. Let us say now the risk reward ratio becomes 1:3. Let's see what is the magic of it. Winning percentage is just 40. Out of 10 trades, you are going to win 4 trades only. So what happens here? 100 rupees you are buying and your target is 130. While your stop loss is same, constant 90 rupees. So 6 trades you lose, your loss is 60 rupees. 4 trades you win, 30 into 4, 120 is the profit. So 120 minus 60, what happens? Still you are in a profit of 60 rupees. That's the power of risk reward ratio 1:3. Even 40% accuracy, you are making more money than 50% accuracy here. So that's how one needs to plan it accordingly. Well, let's take an example of a FinNifty. Let's take 19,800 or X, like something like 20,000 call in FinNifty. 20,000, let us say C we are buying. Okay, 40 rupees. What's the investment? 1,600 rupees. Lot size is 40. I'll buy 20 lots, 50 lots. I have a capital of 50,000. That should not be done. 40 rupees. You are buying 30 rupees is your stop loss. So investment is 1,600. Risk on one lot needs to be calculated. That is 410 points. Target is 60 and 70. So risk reward ratio, if the target is 60, 20 points profit for 10 points risk, 1:2. For 70 target, 1:3. That's the beauty of it. If the 70 is achieved, 1:3. So on an investment of 1,600, you have made 1,200 rupees. On an investment of 1,600, you have made a profit of 800 rupees. So that's great, guys. It's 50%. So for 25% risk, 50% profit. So again, I'm going to explain more in detail in the money management part with this option. So risk reward ratio needs to be intact while we are trading. Let's come back to the presentation, guys. So what is the moral of the story again? You need to have a proper and robust risk reward ratio and risk management mantra. The second mantra is what we are going to discuss is money management. It's not whether you are right or wrong that is important. As quoted by George Soros, he says you are right or wrong is not much important. It is how much money you make when you are right. How much money you make when you are right and how much money you lose when you are wrong will determine your success or failure in trading and investing. Mark it clearly. When you make, you have to make more money. When you lose, you have to lose less. That is where risk and money management will help. There is no foolproof or 100% accuracy strategy, or any advisor will give you 100% calls. If the risk reward ratio is good and he is guiding you on a proper money management, then he is a good advisor for you. Or you are taking your own decisions, manage your risk and money management in a proper way. Now let's start the second mantra, money management with a bang. 2% stop loss rule. A simple rule what we are going to discuss here. 2% stop loss rule is, if you are having a capital of 100 rupees, we are going to have a 2% stop loss rule and we will apply that on the capital and take the trades. So let us make it as a theory. You need to lose 50 consecutive trades. If you have 100 rupees, 50 consecutive trades you need to lose to wash out your capital theoretically, but practically still you will be left with 35% of the capital. You might be wondering, even if you lose 50 consecutive trades, you'll be left with 35% of the capital. How it is, why it is, let me share it with a notepad explanation how and why one needs to have a, like, let us assume I have a capital of 1 lakh. So 2% stop loss we apply. 2% of 1 lakh is 2,000 rupees, which we are risking in one trade. Here FinNifty example what we have taken, 400 rupees means 10 points risk, 400 rupees is the risk. So 5 lots only you should buy in the first trade. If you lose first trade, 2,000 rupees is lost, your capital is 98,000. Then you have to buy only 4 lots. So it keeps on changing, guys, as per your 2% iteration process. 96,400 is your capital. So only 4 lots you can buy. So third trade also you lose, you can buy only 3 lots. So your risk and money management changes as the drawdown goes on. That's how one needs to manage the risk and money management. Let us say you have capital of 100 rupees. Trade 1 you lose 100 rupees. So 2% loss. That's 98. Trade 2 you lose 98. 2% is 96.4. Trade 3 you lose 96.4. 2% is 93.9. So that's how your capital reduces if you lose. So risk reward ratio combined with the money management, what quantity you need to take. Particularly for option traders, what happens, they create a problem for themselves. They take 10 lots in one trade with a conviction and 2 lots in one trade without conviction. The trade which works is 2 lots what they have bought comes into profit, 10 lots what they have bought goes into a loss. That's where they lose the capital in a very big way. So that is very much important to have a right money management in place. Have a clear and right money management in place. If you have a proper money management, you are going to make good money. So what is the ideal model? Just take not more than 1 to 2% of your capital at risk at any point of time. So you need to lose 50 consecutive trades. If you have a 1 lakh capital, 2000 rupees you risk, 50 consecutive, 50 times you have to take a trade and make a loss, 2% you keep a stop loss. Still 2% stop loss you keep. Now you have understood how you will be left with 35,000. Well, I'll give one example. If we toss a coin, we have a two sides of it. One is head and one is tails. Either head or tail can come in. The probability is 50-50. Chance of head and chance of tail is 50-50. You don't know any analysis, you don't have any technical analysis or fundamental analysis knowledge, or you don't have any advisor. You have a 2% stop loss rule. Still, you will be left with 35,000 capital. You lose 50 consecutive trades. But if you toss a coin, head or tail, the chance is 50-50. Without analysis, you are going to win 50% of the time. If your risk reward ratio is good, then you have made a profit. You are not in loss. You don't need the analysis. That's what I am telling. See, if you lose 50 consecutive trades by tossing a coin also, then this is not a business, or any business is not for you. You are the most unluckiest person in this world. So this is the nature of the game. What we need to understand, if we are doing a business, if you have a risk and money management in a proper way, then obviously you are going to sustain. The more you survive in these markets, the more you succeed. Like older the wine, it becomes more sweeter, they say. Always look down, not up. Check the risk first, because risk is guaranteed, reward is potential. So simple rule, apply the 2% stop loss rule. Don't take more than 2% of your capital at risk in any one single trade, and have a good risk reward ratio. That is mantra 1 and mantra 2, two pillars of Ashoka Stambas. Don't adjust your stop losses as per the rule. If the stop loss exceeds, don't take the trade. If it comes into your mode, then only take the trade. Just for the sake of adjusting the 2% stop loss or risk reward ratio, don't adjust the stop loss as per the charts, only take the trade. Trade always with the trend. So this is the second mantra. Now I am going to discuss the third mantra, which is the major thing to become a successful trader. There is always a difference between a lip and a sip. One needs to walk the talk. So three major pillars are there in the third mantra: entry, exit, and error. Three E's are the supreme parameters which one needs to decide how to act upon to become a successful trader. Where to enter, like where to buy; exit, where to sell; error, where is your stop loss, what risk you can take. That in between entry and exit, how patiently and how calmly you sit in a level-headed, balanced and proportionately you divide your money and relaxed manner. That is what we call it as temperament. That is what is required in your trading. Entry point, wait until the target is achieved. On an anxiety or excitement, book early. By 2000 profit I got, book 4000 loss I got, exit, stop loss triggered. 4,000 loss, if you are taking 8,000 or 20,000 profit also you have to make. So when you enter a trade, take a trade and properly manage the stop loss. Trail your stop losses. In the other videos, I'm going to discuss more about the stop losses and exit points, entry points. It's not the technical analysis, it's how you manage the 3 mantras. Ride your profits, cut short your losses, never trade or invest on the money which you can't lose. When you take a position 10 lots, you will be very, very fearful and you will be watching the screen like this, like a burnt cat, like a burnt cat. But hunt like a tiger or a lion when you are hungry. Have a tight stop loss, don't give opportunity even for the error. But if it comes as a stop loss, accept it, move on to the next trade. So entry, exit and stop loss, it's like a software development life cycle of a software development. All the three processes needs to be followed. So never over leverage in any one trade. Take a 2% as I said, or maximum 3% of your capital at risk in one trade. What you can digest and chew, that's what matters in trading. So trade in a prudent way, become a successful trader. Now I am going to discuss hidden mantra to set a goals. Before that, I'm going to explain the maximum pain. Maximum pain model I'm going to explain before getting into the fourth and hidden pillar of Ashoka Stamba. So let us say you have a capital of 5 lakh rupees. I call it as a maximum pain model. 1 month there are 22 trading sessions. Let us say 20 trading days are there in a month after all holidays. Per day you take a risk of 5,000. 5 lakh capital, 5,000 risk, feasible. 1% of my capital at risk. In 20 sessions, I win 40% of the time. Means 8 days I win and I lose 12 days. So 1:1 risk reward ratio, 5,000 rupees risk I am taking and 5,000 rupees profit I am making. 8 days I win, I make a profit of 40,000. 5,000 into 8, 12 days I lose. 5,000 into 12, 60,000 I lose. So what happens? It is a net on net 1 month loss of 20,000 rupees. Similarly, you take a 3,000 rupees as a stop loss, 3%. With a 1 lakh capital, 28 days we win, 8 into 3,000, 24,000 profit, 12 into 3,000, 36,000 loss. So 1:2, let us say when we make a win in 8 days, we make 10,000 rupees into 8, so 80,000 we make a profit. 12 days we lose 5,000 into 12, 60,000. Still we are in a profit of 20,000. 1:3. When you make profits, you make 15,000, and when you lose in that day, you lose 5,000. So 15,000 profit into 8, 1,20,000. 5,000 loss into 12, it's 60,000. So net profit is 60,000 in a month, 5 lakh capital. So this is what one needs to aim at. You need to make 15,000 when you are making in a day. If you have a 5 lakh and you need to lose 5,000. Even 40% of the days you win, you are going to make 60,000 rupees. That's 12% of your capital, which is very big. Let us say even simplify 1 lakh capital, you have 2,000 rupees risk you take in a day. Let me copy the same so that I can simplify. So let's make it for a 2000 rupees. 2 into 1 lakh capital. 8 is 16,000 we make a profit. And 2 into 12 days we make a loss. What happens? 24,000 we lose. So we are in a loss of 12,000. Same 1:2. Now we are going to take 4,000 rupees. We are making a profit. And 2,000 rupees we are making a loss. 8 days we win. 8 for the 32,000 we make as a profit. 12 days we lose 2,000 rupees every day loss. So still we are at a 8,000 rupees profit. Now let's say, let's take it to the next level of 3 times the profit we make in a day. Let's see that 8 days we win 6,000 rupees we profit we make for 8 days. 6 into 8, 48,000 profit. 12 days we lose. So 2,000 rupees loss in a day, that's 24,000. So maximum loss, if you have a 1 lakh capital, 15 to 20,000 you lose in a month, you stop trading. That's what the maximum plain model is. Here see, if you have a 1 lakh capital, 48,000 you make a profit. 8 days we win, 6,000 rupees we make. 12 days we lose, 2,000 rupees we lose, 24,000. So 48,000 minus 24,000, what is the total profit? 24,000. So this should be the goal, those who are having a 1 lakh rupees capital. Weekly 4 to 6,000 rupees should be the target. We need to aim at that. Overall, in an average, we have to make that money in a better risk and money management way, which one needs to follow it in an objective manner to become a successful trader. Now I am going to share the hidden mantra, which is goal setting. The goal setting, adequacy of goal setting, what we need to see. So execution in a proper way, capital required, the right capital required, set your goals and split your goals. One needs to set your goals like 1 lakh capital, I am having 5,000 rupees, 4 to 6,000 rupees you have a target, you plan it accordingly. Split them, execute it in a proper way. Specific goals, measurable, you can attain those goals. The goals should be specific as per your capital. Measurable, it should be attainable, relevant to the time being. So, and the powerful and the most well managed thing what one needs to have is to become a successful champion trader and a businessman and a successful person in life is the mindset. The most beautiful gift God has given to human beings is the mind. The power of mind is until you are in coma, your mind works, you can do wonders in this world. We have seen many wonders, like an example of KFC guy who was trying to commit a suicide at the age of 66. He started the KFC. Now it is 1992, and you are seeing the KFC. So mindset is strong and proper and positive. Impossible also says I am possible. Nothing is impossible. The word itself says I am possible, as quoted by Andre Eppen. Have a positive mindset that you can achieve. Have a realistic goals. Build on it gradually in a planned approach. Like what we have discussed, RMTs and set your goals. The 4 pillars, Ashoka pillars, what we have discussed with the mindset. Repeatedly you practice the same things, you can become definitely a champion and a successful trader. It's because Aristotle has quoted, you are what you repeatedly do. Excellence therefore is not an act but an habit. Practice repeatedly the risk management, money management, trade management. Make it an habit and become a successful trader. Happy trading, guys. We'll be back with more knowledge and information. Signing off for now from Traderz Hut.